Good morning, everybody. This is the live market open for Thursday, March 17th. Happy St. Patrick's Day to our Irish friends. I'm Yohay Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. I see quite a few of you in the room digesting the dollar dive on the doves. That'll be, of course, one of the main topics. And we'll also have today other recent developments, charts and levels, the next 24 hours. And of course, your questions. If you cannot see the chat alongside the video, here it is. Just go to the address here, tlk.io/fxstreet-forex-live-video. During the show, we'll also cover the decision of the Swiss National Bank. Makes its rate decision today. So let's just talk about the overview. Well, the Fed sinks the dollar. We'll dive into that soon, of this dollar doom. It was more dovish than expected. And of course, oil is higher. Stocks are, well, more than a bit higher at the moment. General happy feeling in markets. We had other developments as well. Let's start with just taking a look at the charts, and then we'll talk about the US dollar. Here we are. Even as we speak, the US dollar is extending its falls. Euro dollar at 112.56, and other currencies are looking similar. This also includes the yen, which is falling down. Okay, but let's begin with the reasons and then talk about various charts where we have new levels everywhere. So first of all, the markets were focusing on the dot plot. Okay, what does this dot plot mean? What's the path of future rate hikes? In December, that was the last release of the dot plot. We had 4 rate hikes planned for 2016 this year. This time it's only 2. Now that was quite expected. Everybody knew that good morning, everybody. Everybody knew that expectations from the Fed were a bit too optimistic. All right, no big surprise over there. But anyway, this is still significant. Second development, they're still worried about what's going on in the world, about global development. They still talk about risks. Now, since even their last meeting in January, things have improved. Markets are more markets are more stable. Stock markets are looking okay. Oil prices have bounced from the lows. China's pledged to support growth. The Eurozone also supports growth. So it was surprising to see in the statement this worry. In addition, they also released a forecast for employment growth and inflation. Growth, they expect it to be slightly weaker, but also inflation. Now, yesterday we had an inflation report from the United States. It actually came out better than expected. The core CPI showed 2.3% year over year. Now, the Fed looks at the core PCE price index, and they slashed it from 1.6 expected to 1.2 in 2016. Quite surprising as well, quite dovish. In addition, in the statement, they talked about soft business investment and net exports. Also, sort of looking at the glass half empty, looking at the things that can go wrong rather than a whole picture. And just to show you how dovish it was, we had one dissenter to the hawkish side. Esther George, she's a known hawk. It wasn't surprising. She did want to raise rates this time. It also shows you that the Fed went quite dovish with the statement. And the reaction was a crash of the US dollar across the board. Let's begin with the world's most popular currency pair, euro dollar. It was sliding towards the event, this kind of flag, right? Towards the 110.70 line, even dipping below this line for some time. When the Fed decision was released, boom, we shot up higher. At first struggled with 112.15, which was the previous high, the Draghi-inspired high, and also a veteran line. Now, European morning, we're seeing a second reaction, a move above 112.15. I mean, it's consolidating above this level and even pushing higher above 112.50, which I also marked as it was a line of resistance back here in early February. The only line that I see, well, significant line on the top side is 113.75. This is a level last seen, in the middle of February, when things got worse and the euro enjoyed, when retail sales actually in the United States were terrible. sorry, just before retail sales were good, and before that everything was doom and gloom. So the euro now doesn't enjoy safe haven flows, but just the general dollar weakness. So the euro does not react like a safe haven currency. Also, for me, one of the big surprises yesterday is that the yen did not react like a safe haven currency. That means I would expect the yen to sell off when the mood is better. We have better mood markets, but no, it's just the weakness of the US dollar across the board. We've seen dollar yen pierce through 112.20, under 112. The next line of support is already critical. This is the double bottom here at 111, seen twice in February. Okay, 112.20 now works as resistance. We had trade balance in Japan. It was slightly weaker than expected, but it was ignored. Okay, pound dollar, 142.70 at the moment, back to the high level. We tumbled all the way down to 140.50. Remember, I mentioned this line yesterday. So this line worked perfectly well as support. We had good reasons for the fall. Of course, the looming danger of Brexit is an issue all the time for the pound. And yesterday we had the UK Chancellor of the Exchequer, George Osborne, present the new budget. This new budget, everybody was talking about the sugar tax, well, instead of the corporate tax that was slashed. But more importantly for markets, we've seen the UK government reduce its growth forecasts. So that hurt the pound yesterday. So until the Fed yesterday, cable was trading down, was falling all the way to 140.50. But thanks to the Federal Reserve, it's now battling high resistance once again at 142.80, which was also a line of resistance in early March. Okay, if we have a break above this line, it's 143.60 and 144.40. On the downside, 141.75 and 140.50. Okay, before we move to more currency pairs, comment here from Fabian. The yen is still weak across the board against all the other currencies. Yeah. Yeah, it is. Okay, that's right. Yeah, you're right. The yen is weaker against other currencies, risk currencies. So there we do see the risk, the divergence, the still risk on that weighs on the yen. But against the dollar, the yen would usually slide against the dollar on these kind of risk on moves. And this time the dollar is just the weakest link in general. Okay. So yeah, the US dollar is even weaker than the yen at the moment. Let's continue. Dollar CAD, a big breakout. Wow, we're about to break the round level of 130. Yesterday we had crude oil inventories were also relatively bullish for the Canadian dollar, so this helped as well. But it's mostly the Fed, as you can see. A big fall from here, from the range of 133 to 134.60. Boom, we crashed through 133, 132.80, 132.60, 131.70, which was the previous low right here. And now we're all the way down to 130, the very round number. Further support for the Canadian dollar appears only at 128.30. Let me show you, which was the low back in November. Okay, in October, we reached 128.30, which was also resistance back here in March. Okay, actually 1 year ago we had here a double top on 128.30, then a bottom here. That's the next line if we break under 130. Very good mood also this morning in Europe. Let's continue to the Aussie dollar. Also here we talked about the strength of the Aussie dollar, and this continues. Towards the Fed, we had this false break under 74.40, a line I mentioned, but the Fed, the Aussie can thank Janet Yellen. We had a rise all the way up above 75, above 76, which I mentioned as the previous high here. We're currently at 76.50 almost. We had a jobs report in Australia overnight. It was actually a miss. Australia gained only 300 jobs. At least the unemployment rate fell, but that was thanks to a weak participation rate. Anyway, not such a good jobs report in Australia. Nevertheless, the US dollar is now crashing across the board. The next line of resistance, well, the Aussie dollar is now trading at the highest level since July, since it was winter back in Australia, summer here in Europe. Anyway, the next line of resistance that I see is only at 78.40, followed by 79 and the round number of 80. So also a big breakout for the Aussie dollar despite not so good data. A comment here on CAD. So now dollar CAD is not retracing anymore and trending down. We still see it move as possible retracement. Well, regarding the Canadian dollar, we also learned that on April 17th, it's a weekend. In a month from now, exactly a month from now, we have OPEC and non-OPEC members meeting in Doha, the capital of Qatar, perhaps talking about any kind of production cut. From past experience, we know that these countries are unable to agree with one another, and perhaps we will not have an agreement. But currently, we still have expectations. Anyway, I still see for dollar CAD, looking at the charts, potential for 128.30. The trend, the rise in oil prices, the Dovish Fed, everything, and some improvement in the Canadian economy. This supports a stronger Canadian dollar. Okay, currently the low for today is 130.00. Let's see if we break below this line as we speak. Anyway, no, not so fast. Anyway, this is fueled by fuel prices as well, not only the Dovish Fed. And if we look at oil prices here, 39.54 on WTI crude oil, the highest level since December. Okay, we're at a 3-month high on WTI. So the next level is, of course, 40, the round number. On Brent oil, we're already above 40. Above that, we have 42.70, which was support in the past, and then 43.40. So big risk on the move. But remember, risk on without the yen participating in it. So it's mostly, well, risk on plus euro dollar weakness, okay? Let's say US dollar weakness, okay? Let's continue with the Kiwi dollar. Let's jump over there. The Kiwi dollar also, well, the Kiwi dollar has had reasons to fall this week because of, well, last week because of the RBNZ rate cut, which was surprising, and this week because of milk prices. It was depressed to the downside, almost reaching support at 65.50. But thanks to the Fed, we're now seeing it rise once again. And also thanks to good data in New Zealand, we had GDP coming out better than expected. Year-over-year rise of 2.3%. Now we're challenging this resistance, even topping resistance at 68.20. Let's see if this breakout is confirmed. The next line of resistance is 69. Support remains at the 67 level. Dollar Swiss, well, weakness of the dollar is also felt here. We have a rate decision in Switzerland. We'll talk about that soon. It comes in 15 minutes or so. Anyway, we fell below the around 98 level. Further support is 96.40. Okay. Anyway, let's see what the Swiss National Bank does. Euro Swiss relatively stable. Well, stronger euro against the dollar now 109.89. Almost 110 here. Lots of tension, of course. The Swiss National Bank cares mostly about the value of their currency against the value of the currency against the euro. It trades with its euros.
Before the release.
Sorry about that. Where does this noise come from?
This is a sound test.
Sorry. Okay, here we are. Anyway, let's continue. Euro pound currently under 79. The weakness of the pound is quite strong, quite significant. We have we broke above 78.50 yesterday as the UK government slashed its budgets. 79.30 is the next level of resistance. Okay, so the euro remains stronger than the pound due to the fears of Brexit and the cut of forecast. We have a rate decision also in the UK today. Okay, euro yen. Yeah, finding support here at 125.50, resistance at 127. not a lot of movements right here. 123, 124, around levels work here as support, also 125. Okay, and pound yen. Okay, so this is not a classic. The weakness of the pound is felt also here. We finally broke under 160. 158.50 is the next level, followed by 156.10. Resistance remains, well, now it's 160, and then followed by 162.20 and 163.80. Okay, so we talked about all the major currency pairs and crosses we always talk about. You're welcome to ask questions about further charts. Let's continue with, okay, just to show you what we've seen on the on rate hike expectations regarding the Dovish Fed decision that is killing the dollar. So we talked yesterday about June being 50-50. Now it's 60% against the rate hike in June, according to bond markets. So bond markets are expecting the rate hike, the next rate hike in the United States, to come only in September. Remember, we have elections in November, so I think September is not so realistic. I think that June could still be on the cards if things do improve, if the Fed wakes up and smells the coffee and sees that not everything is so terrible in the United States of America. And then we can have perhaps a rate hike in June and in December after the elections in November. But everything, as Yellen always says, is data dependent. Okay, now let's see other events we had yesterday. See, but I didn't miss it. Everything, because in addition to the Fed, we had so many things going on yesterday. So let's begin from the morning. Yesterday we had the UK jobs report actually come out above expectations, but it was totally overwhelmed by the budget. So we had sort of 0.1 better than expected on wages, 2.1 year over year on wages including bonuses, 2.2 excluding bonuses, and another fall in jobless claims, but no fall in the unemployment rate. So it's slightly better than expected. But UK budget, the lower forecasts weighed on the pound. Things, of course, changed for the pound later on with the Fed, but for the pound against the dollar, not against other currencies. US inflation, as I mentioned, beat expectations. 2.3 year over year on core inflation, 1% on headline inflation despite the fall in oil prices. Really good news from that inflation front, but the Fed focuses on another inflation number, and also well, decided to see the glass half empty. We also at the same time had housing figures. Again, one of them came out a bit better than expected, the other worse. Everything was overshadowed by the Fed and also in inflation figures. U.S. industrial output missed a bit with a fall of 0.5, didn't have a lot of impact. As I mentioned before, New Zealand GDP added fuel to the fire on the rise of the pound, of the kiwi, with 0.9 better than 0.6 expected and 2.3 year over year better than 2.1 expected. The Australian jobs report missed. Let's just look at the numbers a bit more closely. So we had an expectation for a rise of 10,000 jobs. Only 300 jobs were gained. The positive here is that full-time jobs were added and part-time jobs were lost, so it's a good composition. And the unemployment rate dropped in Australia from 6% to 5.8%, but that was fueled by a drop in the participation rate, so it can be, it's not that significant. Anyway, there was an expectation for a bigger gain in jobs, and that didn't happen. Okay. Well, Chinese foreign direct investment advanced by 1.8%. We didn't have expectations. And what else did I miss? Japanese trade balance missed by just a bit, not that significant, as you can see. Okay, so the next event on the agenda, of course, any questions are welcome, comes in 10 minutes. We have the rate decision from the Swiss National Bank. Okay. Yeah, 10 minutes for the SNB. Let's talk a bit about that. First of all, the Swiss National Bank is special. It makes its LIBOR rate decisions only once every 3 months, okay? So it's around 3 months, the last month of every quarter. So it's March, June, September, and December. It's important to remember that the big SN bomb of last year of January 15th did not come as a scheduled rate decision, but came as a total surprise. So the fact that we have a rate decision doesn't mean, well, the biggest news will come now, but it doesn't matter. So currently the interest rate is negative, minus 0.75. This was actually lowered back in January 2015 when the Swiss National Bank removed the peg. It tried to mitigate the removal of the peg with trying to discourage people from parking their money in Swiss banks. In Switzerland in general, they tried to weaken the franc by doing that to discourage inflows. Since then, they've left the interest rate unchanged. Since then, they've pledged and they have intervened in foreign exchange markets. Nobody is telling them anything about that because, well, many people have bank accounts over there. Anyway, we have today no changes expected in the Swiss interest rate. It's expected to remain negative 0.75. The expectations for a move come from the fact that the ECB, European Central Bank, recently lowered the negative deposit rate from minus 30 to minus 40 and the main lending rate from 0.05 to a flat 0. And perhaps the Swiss want to compete with that and set an even lower rate in order to keep Euro Swiss higher, in order to keep the euro stronger than the franc. But especially given the dovishness from the Fed and the current exchange rate, I don't see any need for them to do that. What I do expect them is to remain committed to maintaining the exchange rate, saying once again we're ready to intervene whenever necessary, saying once again that they will do whatever it takes or something of that sort. They're watching markets, some kind of strong statement of vigilance, but not any change in policy. Okay. If we will see a move, it will be on Euro Swiss. Levels to watch here. Well, currently it's a bit higher, getting closer to 110. It already reached 112 earlier this year. 108 would be the low line. Anyway, we're at the 109 handle. Here's a comment. I don't really understand why the sell-off in the US dollar is quite so big. No one really believed the Fed was going to raise rates 3 times this year. The US economy is growing fairly well, especially compared to the rest of the world. Do you think this sell-off is an overreaction? No, I don't think the sell-off is an overreaction. I was also very surprised by the dovish tone, not by the dot plot. Again, it's not the fact that everybody knew that the Fed is not going to raise rates 4 times. Everybody knew that they will lower the dot plot from 4 rate hikes to 2, probably. It wasn't such a big surprise. There were other surprises. Regarding the dot plot, they also lowered forecasts for the next 2 years, for 2017 and 2018. The bigger surprise for me was that they slashed inflation forecasts, despite some signs of rising inflation. So why did they choose to look at the worst data and emphasize it, not some positive stuff? Why did they see soft investment while durable goods orders are showing some pickup in investment? Okay, why are they talking about weak global growth, which of course is not new, but we did see some signs of improvement, some pledges from China to keep up growth, and commodity prices are rising, and it's not all that dark anymore. And also, so what else did they say there? Anyway, they were the Fed is in general dovish, okay, but this was dovish extreme. So of course, if data improves, the Fed will rethink. There are some hawkish members of the Fed, like Stanley Fischer, number 2 of the Fed, the vice chair, but he also voted with Chair Yellen on this statement. Okay, so there was only one hawkish dissenter. We'll get the meeting minutes later on in 2-3 weeks. And then we'll see a bit more. Next rate decision in April, and no rate hike is expected. But I still see an open door for rate hike in June, even though the Fed seemed very dovish. If data does remain okay, it doesn't need to really improve, then, and the dollar weakens, of course, that's also a factor. Maybe they want to weaken the dollar, I'm not sure, but you never know. Then we could still see a rate hike in June, okay? More questions here. Think they turn dollar to keep oil prices down. The Fed would not like oil prices too low, under $30. Why? Because, yeah, it's good for the US consumer, but if prices become extremely low, it has less of an impact on the US consumer. I mean, less of an added value and a much more negative impact on the US economy from the fall in US production of oil, of the mining sector. So I believe that the sweet spot for US shale oil is around $50, $60 a barrel. We're not there, but at $25, it's a real issue. Okay. Which Swiss franc pair has the most potential for movement? Euro Swiss, that's where they care about it most. So I think Mario is taking notes. Yeah, I'm sure he is. I'm sure he's watching, eating his fingernails as we speak, waiting for the Swiss rate decision and hoping that they will do what markets expect them to do and not change policy and not rock the boat too much. Okay, so we have 3 more minutes for that. And let's talk a bit about events we have later on today. And don't worry, I have one. We have a question actually. Draghi was not only trying to keep euro weak, which didn't succeed, right? But also had other objectives with banks, for example, right? Yeah. Mario Draghi also wanted to keep banks happy, okay? Means setting a negative deposit rate, which would be too low, would hurt bank profits. Banks in the Eurozone are still, some of them are still in a vulnerable situation since the crisis. Nobody believes that stress tests anyway. Everybody's worried about non-performing loans. He also has worries. He also wanted to move the ball to the court of governments. Okay, so he said, okay, we did enough for now, at least. Now it's your turn to take action. That means 2 things: structural reform and also fiscal stimulus. He didn't say that. Well, he says structural reform in a more clear manner, but he also wants stimulus. Anyway, yeah, Draghi would like a weaker euro, would like more lending, would like governments to do more in general. Okay, 2 more minutes. Keeping an eye open. Okay, we have the Swiss National Bank decision. We have final Eurozone inflation figures at 10 GMT. We're after the ECB decision, so it's not that dramatic. If we have any kind of revisions, we have the UK rate decision at 12 GMT. We'll talk about that a bit more in detail soon after the Swiss National Bank decision. At 12:30, we have the US jobless claims and the Philly Fed figures. At 2 GMT, the JOLTS report, another jobs figure. We'll detail about everything soon. And the Bank of Japan meeting minute 12. That shouldn't be such a big event. Now we'll focus on the next big events of today,
1 minute before
which
the
are
release. Stand by.
1 more minute towards the release. Remember, there is a small delay between when I see the data and when I say something and you hear me in general. Okay, let's look at the Euro Swiss chart to see the potential reaction. 30-minute chart would serve better here. Okay, so according to my clock, it's 30 seconds to go. Remember, there's a small delay. How did cable get a free ride? We'll talk about that soon. Yeah, so 20 seconds to go. 110, I guess, is level to watch if the Swiss surprise us with something. And 10 seconds.
Before the release. Stand by.
Let's see. tick tock, tick tock, tick tock. Oh, surprise! They raised rates to minus 0.25. Quite a big surprise. I hope I am getting the correct data. Anyway, Euro Swiss is sliding just a bit. Let me get the data for you. Why did they raise rates? Or maybe they raised another rate and I'm getting the wrong figures. Let me check out all my news wires. No, sorry. Okay, the 3-month LIBOR upper target remains minus 1.25, but the lower target rate is minus 0.25. So they do have sort of a band, and they widened the band. Anyway, the reaction on Euro Swiss is absolutely nothing. 109.85. Let's also look at dollar Swiss. In the past, well, as a reaction to the decision, dollar Swiss fell quite a lot, but as a reaction to the decision, it's not moving. Yeah, well, anyway, the deposit rate remained unchanged at minus 0.75. They did lower the target rate. That's what caused the confusion. But what's important, the deposit rate, like with the ECB, that's what we're looking at, remained unchanged at minus 0.75. Yeah, no rate rise. Sorry, I was looking at the wrong figure. The lower target rate was 1.25. Anyway, we're not seeing any reaction. As I said, sorry for the incorrect data. Anyway, we're not seeing any reaction. It's yeah, minus 0.75 on the deposit rate. No change, no reaction. As I said, there's no reason for the Swiss authorities to act because Euro Swiss is currently at relatively more comfortable levels for them. Okay. Yeah. Here we are, minus 0.75. Sorry for the confusion. Anyway, no change from the Swiss National Bank. Let's take another look at the chart. Euro Swiss is sliding just a bit, 109.82. It was on 109.86. Before the release, we cannot call this a reaction. So it moved just a bit before the release, now a bit down. Well, in general, nothing to see here. Let's move along. I'll try to get more headlines for you regarding that, but I think it's quite a non-event. Okay. Yeah, it's falling a bit, but nothing I would say very, very significant. I'll try to pick up some headlines for you. But in the meantime, yeah, they do say that the negative rates make the franc less attractive. It's not new. It's the same rate since since January 2015, more than a year ago. They'd still continue complaining about the strength of the Swiss franc. It remains overvalued. They will remain active in currency markets. That means, yes, we are intervening, and we will continue intervening. Regarding some domestic developments, they see a downward trend in real estate, and it's been confirmed. But that doesn't really have an impact on currency markets, what's going on in the Swiss housing sector. Okay. Yeah, here's a comment here, dollar CAD falling below. Quite a dramatic fall. Yeah, I was looking to see that while I was covering earlier the Canadian dollar. Well, now we're at 129.75. Basically, it fell out of bed, fell out of under the round level of 130. Okay. So here we are, 129.72 has been the low so far. We can certainly go lower. As I mentioned before, the next line to watch in dollar CAD is 128.30. Worked here as a double top in early 2015, and then as a bottom, as the low line in October. Okay, so very, very important line. Yes, the Bank of England is next. Let's talk about the upcoming events for today. Give you sort of a brief overview, but let's focus on these events. Let's look at the Swiss National Bank was an uninteresting event. We do have the final Eurozone inflation figures. No change is expected from the initial release. A drop of 0.2 in headline prices and a rise of 0.7 year over year in core inflation. Maybe we'll see a tick up in core inflation. Maybe not. Shouldn't have a significant impact unless it's a really wild revision. We also have trade balance from the Eurozone, expected to show a slightly narrower deficit, narrower surplus of 20.2 billion. Nothing really big. Okay. A big decision today, the fourth rate decision actually for this week. We had the Bank of Japan, the Fed, the Swiss, and now the Bank of England is, the Bank of England's the last one. So the Bank of England, in the past, almost a year, I think, releases the meeting minutes alongside the decision. We're not expecting any change. The interest rate in the United Kingdom is expected to remain unchanged at 0.5. It's actually the 7-year anniversary for this rate. The last time the Bank of England changed rates was in March 2009. Mark Carney is in his job nearly 3 years, since the summer of 2013, and he never made a policy change. Okay, he's getting quite a nice salary for doing that or not doing anything. Also, the QE level last changed in 2012 is not expected to move from £375. What we're looking at is the meeting minutes. Last time we had a shift, we had one member, Ian McCafferty, that voted for a rate hike beforehand, shifting to the dovish camp, voting against the change, okay, acknowledging reality that the UK economy is slowing down. This time we're expecting a repeat of that. More importantly, we're expecting, the tone of the statement. How does the Bank of England see the economy? What's going on with inflation, global development, employment, everything basically we also expect from the Fed. I suspect the sentiment will be dovish because everybody else is dovish, first and foremost. The ECB is dovish, also the Bank of Japan, the door open, and of course the Fed yesterday they outdid themselves with going extremely dovish. Okay, that's one reason. The second reason is there's a genuine slowdown in the UK economy. Purchasing managers indices are sliding. Okay, growth is falling and is slowing, expected to slow further. And one thing they cannot really directly talk about, but it's the uncertainty about the Brexit. Okay, the Bank of England, beneath their academic and non-political image, they do have an opinion. They don't want a Brexit. They want the status quo to remain. They want the UK to remain in the EU, to maintain trade relations. I don't think they'll say directly Brexit, but they will warn about uncertainty, okay, and in quite a few manners, and I believe that will hurt the pound. And as someone mentioned here, I think I missed that comment, that Cable got a free ride on the Fed's dovishness, okay? So, that's how Cable got a free ride, because of the lower growth forecasts. Well, the lower growth forecast from the government should have shown us otherwise. I think this will put pound back in place. The pound did lose ground against the euro and the yen, and I believe that if indeed Mark Carney and his colleagues at the Bank of England go dovish, we'll have the pound sort of Cable erase some of its gains at least. The rally is unjustified. It's the weakness of the dollar more than anything else. Okay, so that's at 12 GMT, 1 p.m. here in Europe. Okay, what else do we have today? I think the Bank of England is the main event for today, of course. Well, I think that's what And we have the U.S. jobless claims and the Philly Fed index. U.S. jobless claims is a weekly event. It's expected. Last week it was really great. It showed 259,000, which is very low. This time a small rise to 268 is expected. At the same time, we have the Philly Fed Manufacturing Index expected to improve but remain negative from minus 2.8 to minus 1.7. So that will be a positive development, but the New York index beat with a positive figure. So perhaps we could have some improvement, some bounce in the battered US manufacturing sector, US industry. Wholesale sales in Canada, usually not such a big event. Oil prices have much more of an impact. And US job openings, this is an employment figure that the Fed watches quite closely. Was quite strong in the past year or two. Ben Bernanke initially mentioned it, and Janet Yellen also looks at it. The number of job openings expected to slide just a bit from 5.6 to 5.57, or 5.5. Anyway, we're expecting here. It's also important here to look at the number of quits. When a person quits his or her job, that means that there's enough confidence to try something new and perhaps wage gain. So if we have a rise in the number of quits, it's positive. If we have a drop, it's negative. It's just another secondary employment figure worth watching, but shouldn't have a really big impact, just a bit. Okay, also have the CB leading indicator in the United States. Shouldn't be that important. And overnight, we have the Bank of Japan's monetary policy meeting minutes. These are meeting minutes from the decision, not from the last one, but from the previous one. And we should have an idea of why they decided to set the negative rates. But usually the meeting minutes don't move markets. I think the Bank of England's rate decision is the most important event today. Okay, another question here. 7-year itch, yeah. 7 years without changing rates. Yeah. BOE over for move. A question, what is the relation between the dollar and oil? Well, when we have the dollar rising, we have oil falling, and the other way around. Oil prices are currently rising. 39.50, 39.59 has been the high. It goes hand in hand with the fall of the US dollar. The US dollar, when it worked in the past in a better manner as a safe haven currency, when oil prices fell, it went up. Now it's not that clear, but in general, a positive market mood is good for oil, bad for the dollar, and that's what we're seeing now. Okay. Wow, quite a rise in euro dollar as well, getting very close to 113. So really a huge dollar sell-off. Pairs to watch for the Bank of England. I would say perhaps, well, focus on the main one, on pound dollar, because here we had quite a rally, and perhaps we'll have something, a retracement over here. Okay, that's the one for the Bank of England. All right. The pound is the main currency pair. Of course, we'll have moves also against the euro and the yen, but perhaps the strongest one could be against the US dollar, because we had the strongest move to one direction here to the upside, and perhaps we'll see it falling back down. Okay. Let's move on to the wrap up for today. This is the wrap up for the live market open for St. Patrick's Day, March 17th. It's a Thursday. Clearly, the main event is the Fed still having an impact on markets, hitting the dollar really, really hard. The Fed went full dovish yesterday, not only lowered the dot plot, which was expected to rate hikes in 2016. They're still worried about global developments despite some stability. They're seeing the quarter glass half empty. On inflation, they slashed inflation forecasts on the same day that inflation was actually higher than expected and above their target. They did mention soft business investment despite some improvement there, and soft business exports. And to show how dovish it was, there was one hawkish dissenter. This member, Esther George, did not dissent in the past. The US dollar crashed in the immediate aftermath and continues its spectacular fall during this European session. Okay, let's look at the charts and then talk about other events yesterday and today in this wrap-up. Euro dollar currently 112.90. Next line of resistance is very strong, 113.75. Support 112.50, 112.15, and 110.70. Above 113.75, we have 114.60 and 115. Euro dollar was grinding lower and then shooting back up, beating the post-Draghi highs. Pound dollar had lots of reasons to fall, especially that the UK government slashed the growth forecasts and the general uncertainty about the Brexit. We had the pair fall very nicely to very round support at 140.50. From there, we have an amazing bounce, 250 pips already, above resistance now at 142.80. Next resistance, 143.60 and 144.40. But we have a rate decision later on. What's also surprising is with this better mood in markets, stocks rising, oil rising, risk currencies rising, but also the yen is rising against the US dollar. It crashed from the previous range above at the 113 handle, even below 112.20 support, currently at 111.60. Very, very strong support at 111, a double bottom there. 112.20 turns into resistance. Dollar CAD, spectacular crash also because crude oil inventories showed were sort of bullish for oil, and also we have a meeting between OPEC and non-OPEC members in exactly 1 month's time. So the Canadian dollar had reasons to rally on its own, under 130, extending its fall to already 129.45. Very strong support at 128.30. 130 now turns into resistance. So it's the weakness of the dollar, US dollar, and also rising oil prices supporting CAD. Aussie dollar had a weak jobs report overnight. It only temporarily halted the rise of the Australian dollar, which enjoys the Fed's dovishness. We had a false break under 74.40. Since then, we're 200 pips higher, breaking above the previous high of 76. Next line of resistance is above 78.40, followed by 79 and 80, 76 and 75 are support. Kiwi dollar, well, got some bad news this week with milk prices, but yesterday the Fed's dovishness and better than expected GDP, 2.3% gain year over year, better than expected. Now the pair is trying to break above the previous resistance line of 68.20. Next resistance is 69 and 70. 68.20, if confirmed, turns into support, followed by 67. Okay, so a huge dollar sell-off across the board. Next rate hike is expected only for September. It was beforehand in June. Very, very, very dovish. We talked about events that came out yesterday. A few more to mention are that housing figures in the US were mixed. Inflation, as I mentioned, came out better than expected, just exacerbating the surprise with what the Fed said about inflation. Trade balance missed in Japan. Today we had the Swiss National Bank's decision. Let's take another look at that. No changes in there. Sorry beforehand about the confusion. We have your Swiss exactly in the same place where it was before the release, 109.89. So in the last 30 minutes, no material changes. The 109 handle is the area where this pair trades. 110, perhaps some resistance. Anyway, it remains boring. But we will have action, a bit of action from the European Eurozone final inflation figures at 10 GMT. Weak inflation will probably be confirmed. No changes are expected. The big event for today is the UK rate decision at 12 GMT. No change in rates is expected, but the Bank of England will probably join other dovish central banks. It's hard to surprise with dovishness, but you never know. Okay, at 12:30 GMT, we have jobless claims in the United States, which were really good last time. Let's see if this continues. And the Philly Fed, another industrial figure from the United States. Will we see an ongoing bounce in this battered sector? It's a question. So 12:30 GMT is sort of an opportunity for another look at the US dollar. At 2 GMT, we have the JOLTS report in the United States, a secondary jobs figure, but important for the Fed. Watch the number of quits over there. And, well, overnight, we have the Bank of Japan's meeting minutes. Okay, so very, very busy week in the markets, very busy 24 hours with so many data points. First and foremost, the Federal Reserve killing the dollar. Maybe they did it on purpose. I don't know. Anyway, another thing, oil prices also gained thanks to the Fed, with WTI crude oil reaching highest levels in 3 months, getting closer to $40. I'm sure that many shale producers in the US are delighted. This will also make OPEC members slightly less inclined to cut production. So it's good for stocks, good for oil, good for everything basically, except the poor US dollar. Okay, yeah, that's it. So before we head off, I see a few more questions. We can now officially kiss goodbye euro-dollar parity for this year. Yeah, some banks still expect parity. I was not talking about parity, but I did expect euro-dollar to fall. I did expect the Fed to go a bit more hawkish, at least not that dovish, not so extremely dovish. Euro-dollar anyway, next resistance 113.75. CAD still sliding. Yeah, dollar CAD. Yeah, well, the low for now is 129.45. Currently at 129.70. Between 128.30 and 130 is the range I see. Very, very exciting days in markets. So that's it for today. Wish everybody a safe and successful trading day. I hope you enjoyed, those of you that came to the live coverage yesterday, enjoyed the show, and that you enjoyed the show today. We'll be here tomorrow with the events that we had this weekend, of course, with what's going on tomorrow, and a preview for next week, as we do every Friday. Next week is we have here in Spain, it's Semana Santa, the Holy Week. Anyway, the week before Easter, and next week we have weekend. It's a long weekend. Not this one. This one is a regular one, but the next one, the last one of March, is very busy. Okay. Anyway, thank you very much, everybody, for coming. See lots of people here in the room. Lots of excitement. Looking forward to your questions and to the show in general tomorrow. So that's it for today. Thank you and bye-bye.